you guys having me here and bringing me on.
Well, of course you have to be here. You are part of the Palantir community. You bought Palantir at DPO. I'm very excited that you are here. Here's my first question to you as well. Raw thoughts going to earnings. You anxious, nervous? Kind of how are you feeling as we wait for these numbers?
I agree with a lot of what Amir said, right? I mean, a lot of the things that we're seeing kind of come to fruition have been things that we've thought about, dreamed about, interacted with the company over the past several years. And in my case, 6-7 years dealing with the company at UDoc. And
Matt actually uses Palantir every day, for those that don't know.
Yeah, so it's fun. And at the end of the day, I mean, I think a lot of this, yes, you could say that it's overvalued here. You could say, that it should tank on earnings. If we don't get to 40%, that's fine. But I think what we're still seeing is the foundations of a company that really is going to rival some of the big tech companies that we see in the Magnificent Seven. And I don't think that people fully recognize that. It's been something that I've been saying for quite some time, and I feel like you guys feel the same. I think Steve says this very frequently as well. Like, he thinks that it could rival Microsoft. I think in the long term, actually, Palantir will overtake Microsoft in terms of the maybe not necessarily revenue in the short term, but in terms of the premier business software and enterprise software that truly fundamentally makes a difference. Keep in mind, Microsoft has a 40, 50 year sort of advance when it comes to technology and being able to kind of go public in that respect. And Palantir's only been around for 20 years. So if you really give it the same amount of time, I anticipate that Palantir will do its job and will come very quickly in terms of being able to catch up. You think it's really only been a commercial platform now since, I guess, 6 or 7 years ago, since it kind of started up with UDoc, GM, and a few other big contracts. And so really it's only 7-year company in terms of actually trying to perfect the commercial side of the business. And it's been a fun and wild ride to see them grow. And I'm curious to see, I have some people chirping about $1 billion in revenue. I think that's a tall ask, but hey, I mean, kudos to Amir, because last quarter, in the fourth quarter, he said we're going to hit north of 10% quarter-over-quarter growth, and we hit 14. And I thought he was a crazy person, and he showed me wrong, or showed me right. Sorry, he proved me wrong.
No one saw it coming, man. They blew Q4 out of the water. Yeah.
So let's get into that question then. All right. So analyst expectations are 862 million. That would be 36% growth. That would be 0% change quarter over quarter in terms of the growth rates. If we want to get to that elusive 40%, they need to do about 890 million, and above 40% would be anywhere above 900 million. $1 billion, I think, would get closer to 50%. Amir, what do you think the growth rate is going to be?
Look, I think if Kalshi had odds on like meeting analyst expectations, I think the odds of a miss would be like 1%. I think it's like there's no way. So I made a tweet today. I was like, well, I believe I feel it's pretty certain. Like, of course, everyone is wrong once in a while, even me. I believe that we will see a 4 handle regardless. The question is just, what's the other number? And actually, I've gone very bullish. Or, well, I think it's a probable scenario. I think 48% roughly. So I have them doing 41. I think 1 billion is like it's quite optimistic. It's like 58% year over year. I think 48, and the way we get there is basically doing 52% to government, which is an increase of roughly 170 million compared to the year prior. I think government will be strong this quarter, but especially Q2. But we're not going to get into that yet. And also 44% on the commercial side year over year. So I think it's quite reasonable, especially like on a raw. As Matt was mentioning for the previous quarter, the thing that we underestimate is how much is from new customers and how much is from old customers. Like, they are scaling their current customer base, which is ever increasing. Last quarter, we had 120% net dollar retention, meaning that customers that have been with Palantir for more than a year actually grew their revenues 20%. So you already have that inherent, like already within like your customer base, they are scaling, they are growing. So from new customers, you don't really have to perform all that much. But I still believe that 124% net dollar retention, in my opinion, and then the rest from new customers for that 48% is the way I see it right now.
I don't think that's crazy. I don't think that's crazy. Matt made a really good point on Palantir Weekly that if Palantir's revenue stayed flat, it would be 31% year over year. If you assume analyst expectations, which they have beaten for the past 8 quarters, it would be 36%. It's not that crazy to say they're going to beat expectations. And if they beat by anywhere near how they beat in Q4, you kind of get closer to that 940, 950 million number that Amir's talked about. Matt, you've had a couple days to think about it ever since Palantir Weekly. Any expectations on the growth rates for this quarter?
Yeah, I mean, I'm just putting some caveats out there. I mean, some people made some phenomenal points. I mean, the 31%, even if you stay at a 0% quarter over quarter sequential sort of growth, that's pretty impressive. And I think Amir is kind of making me think that I'm being too bearish when it comes to the quarter, just with those great numbers, right? The net dollar retention over 120% last quarter. I anticipate that's going to continue to be strong. So I'm sitting here like trying to understand. I mean, I don't think we're going to have low single digit quarter over quarter. I mean, these guys have been proving themselves with respect to boot camps and things of the like. So when it comes to actual revenue growth, I mean, I'd be hard pressed to say it'd be north of 10%, but once again, I was humbled last quarter. So I mean, I think that kind of puts a stop on like 910 million, but at the same time, listening to Amir, I'm like, I don't know, should I go to 11, 12% quarter over quarter growth? I don't know. I mean, it's crazy to think. I mean, not only are you talking about just flat growth being 31% from quarter over quarter, year over year, revenue growth, but if you actually add net dollar retention of growing 120%, you start to think like, I mean, shit, I don't know. Makes me think that you might go north of 910 million in the quarter, but I don't know. I'm going to stick with 880, 885 for my revenue. The thing that I'm still kind of curious about is where does that show up in net margins and cash from operations and cash margins. I'm going to say we're at like 28% cash margins. Which is still very, very healthy. Gross margins, I think, will be 82, 83%. That stays rather consistent, but still impressive that it's grown from 80 to 83%. I don't know, man. It's just a phenomenal business in terms of just where we've seen it grow. And now every single dollar that we get in terms of revenue is truly impacting the bottom line, which I think is something that's new to us over the past 8-9 quarters, right? I mean, before that, we were just like, when profitability, and now it's like every dollar that you get is 20 to 40% of it's hitting the bottom line. It's pretty insane.
I think you make a great point, actually. Like, everything you said made sense. You could argue for what I said as well, but that's the key thing here. The stock is very volatile, and I think that's simply because it's so difficult to tell where is Palantir headed. I mean, as you mentioned, just looking quarter over quarter, just prior to this 14, they had 7%, and they just doubled that from Q3 to Q4. So like, no one can really tell, and I think that's a big reason for why the stock is so volatile, why it can have such dramatic swings back and forth. I think no one really knows. I mean, we can do our best guesses based on what we have analyzed, but I think it's healthy to have this discussion, especially when you are on opposite ends of the argument. So it's going to be really interesting.
Crazy.
Yeah,
it's so fun. Like, it's so crazy. You don't know what the hell's going to happen. Are they going to come in? And that's the thing. It's like, even still, like, even with single digits, it's like, who knows what they could come in with next quarter? Because I mean, like, the thing that's so beautiful, and this is why I wish they broke it down a little bit more about the cohorts and what's in particularly like the build stage versus like the growth stage, etc. It's like, there's been so many customers onboarded that you don't know which ones are actually generating revenue and which ones aren't. And how long they've been there, right? Some of these customers could be in the kind of beginning phase for 18 to 24 months, and now they're just starting to hit revenue. And, it's really going to start to hit the top line and bottom line versus, these guys are going out there and starting with, let's just do a dollar contract. And that, I feel like that happens so often. They'll say, let's do a dollar contract. We'll work for you for free for however long, and we'll figure it out. And the problem is we don't see the breakdown as to what of the 3 buckets they're in. And it would be really nice to be able to see that.
So the big part that makes this so difficult to me is we broke it down many weeklies ago now. This was end of last year, but I can't remember which firm it was that came out with the Wall Street report, but it was really detailed, centered around AIP. Maybe
UBS.
Yeah, UBS, good. And the way they wrote it is that after talking to partners of Palantir and customers, it all depends on how much you adopt AIP. Some companies, they only use AIP to solve one use case. And then, of course, the incremental revenue increase is quite small because you only use it for that one use case and you are charged based on usage. And then there are companies that utilize it for their whole business, like they run their enterprise business on AIP, and those saw more than double the revenue from those customers. And this is all like what makes it so difficult, because we don't really know how AIP adoption looks like. I know our friend Dan Ice asks that all the time, like, okay, well, what's the adoption rate from bootcamps and stuff? I mean actual adoption within businesses that use AIP, because it makes sense. Like, okay, let's try out AIP. We use it for one use case. Oh, this pretty good, and then you scale that out and use it for more and more use cases. But I mean, what the UBS report showed is that for companies that utilize AIP like everywhere, like how much Palantir can build them can go like more than 2x. Like there were some customers that were built 3x the amount compared to just Foundry. So that's what's going to be so beautiful to see in the revenue scaling, because as they adopt AIP more, and because it is usage based, we're going to see this huge increase within the cohorts. And I do agree with Matt that it's a really shame that they stopped reporting cohort growth, especially after the last time they reported it. Alex Karp had this quote like, and the phoenix rises, because it looked so impressive, right? How like the previous year's cohort were like scaling massively, and then they just stopped with that. So yeah, it's a real shame that we don't get that behind the scenes. What I would love, we're not going to get that for Q1, of course. Typically they do this on the annual releases, like when they introduce new metrics. I would love to see a product revenue aggregation. I want to see how much is AIP bringing in, how much is Foundry. We don't get that. We only get the government and commercial, and then the regional, like US commercial, international, and so forth. So that's also a shame. I wish in the future, perhaps for 2026, that we will get that product aggregation as well.
We got about 10 minutes until numbers come out. It'll probably be like 4:05-ish, so it might not be exactly at 4 p.m. So we will do our best to get those numbers as soon as we get it. Here's another question: margins. So let's say top line revenue maybe is not as explosive. Operating income margins are at 45%, free cash flow margins 60%. Do you guys think margins actually continue to go higher? Because if they do, I think there might be a nice little beat on EPS as well. Matt, we'll throw that to you.
For sure. I do want to say, I think Amir's right. I would love to see the breakdown by brand, because a lot of companies, not even specifically technology, but like Procter & Gamble or Clorox or PepsiCo, they all talk about how many billion-dollar brands they have. And so I know right now we're talking about, getting to a $3.5 to $4 billion run rate by the end of the year. So, there's only 4 or 5 products within Palantir in total, but it would be cool to be able to see, which ones have become their own sort of unicorn in that respect, which ones have hit that $1 billion mark. And it would be cool to be able to see how they scale up over time and really track that. So maybe not for today, or maybe not for the next couple quarters, but eventually maybe when they have 2 or 3 different $1 billion brands, I would love to see that. In terms of margins, I think cash ops margins will crush or compact this year, or this quarter particularly. We came from 56% last quarter, which I think is a massive influx of cash that was able to be realized into the group. So I think that that'll probably, collapse a little bit closer to the upper 30s, or maybe low 30s%, if not maybe even the high 20s. But overall, I still think that they've seen a massively good trend line with respect to margins. And maybe actually, in fact, instead of just me doing it, I can share kind of my sorry to steal your thunder.
No, you got it. You got it. Let's do it.
Let's see. Sorry, my mouse wheel is being weird for some reason, but here's kind of the previous several margins. You can see from like income margin, it's been really good over the past several quarters. And then obviously we've really hit a strag with the share-based compensation. But I think that this should easily get back to 16% unless there's some sort of massive impact. So this red has been a beautiful trend line since we've kind of hit profitability, and even slightly before then. So I anticipate this getting to 16, 17%. Cash from ops, this is kind of like wobbly. We've talked about this in the past. The first quarter generally kind of comes down. I'm anticipating it's probably going to roll over to the 30s at some point. So 56%, I think, is something that might be a little bit aggressive. But then when you get to like the actual net margins, I think that similar as well, should be 16, 17%, continuing this nice trend line that we kind of have. But to me, I mean, to give everyone's eyes into this is what really matters, is this cash flow margin here, because this is really what ends up showing up in the door, right? Where you actually add to the balance sheet, that $5 billion that we want to continue to add to. And so when you talk about, let's say, last quarter, you saw massive actual cash entering the door, but the revenue growth obviously was very good as well. So even though you had a net income of X, that was kind of like funny money, like non-cash in real terms. So this is what I've always been looking at, and being able to say grow every single dollar that you have in terms of revenue, say ends up as 30 or 40 cents on the actual balance sheet, is what matters to me, knowing that this company has very low capital expenditure, and really the only thing that offsets the cash coming into the organization is that share-based compensation, which once again is non-cash. So you have this beautiful cash flow into the organization, but you have this non-cash event that shows up, in the order of $150 million every single quarter. So net income continuing to get back, hopefully growing towards 20%, but cash margins hopefully getting closer to 30, 35% still.
Amir, any thoughts on margins and if we could inflect today with them? You're muted.
You're muted, friend.
Amit muted me. Was I being loud?
I definitely did not mute you. That was
okay. I'm here. So yeah, I think the interest rates were still pretty attractive throughout Q1. So I think net income will probably still be above 20%, the way it was the previous 3 quarters. I mean, excluding SARS, we were pretty consistent at 20. I'm kind of hoping that goes up, because I see operating margins moving to 20% either this quarter or next quarter. And during the weeklies, for the guys that have been here, we've kind of looked at the operating expenses and how they're kind of they are slightly growing, while for some quarters some of the operating expenses are flat, but in general they are trending upwards, but very slowly, and the revenue is very explosive. So this creates this beautiful what would you call it,
trajectory.
Yeah, this creates this beautiful trajectory where the margins are consistently going up. So I'm kind of hoping operating margins at least 18% for this quarter, and then net income margins 21 or 22. But looking at the free cash flow margins, the way Palantir reports it is that they add back stock-based compensation in their adjusted free cash flow. And I was kind of shocked when we got the 57 in Q3, and then we got above 60 for Q4. So that's obviously been super strong. So it was 62.6, I believe. If we can keep above 60% adjusted free cash flow margins, that would be my expectation. Not my expectation, but I would be very happy with that. If we can just stabilize around that area, because as Matt mentioned, it's very capital light. I mean, capital expenditures are like 3 million, like 3-4 million. Like it's nothing in the grand scheme of things. So if we can stay at around 60%, or even high 50s, that would be great. On a free cash flow to the firm basis, which is what I use when I value the business, where I add back all the reinvestments, if we can be around 50%, that would be great. But yeah, in general, margins should be improving because they have this dynamic where revenue is explosively growing and the expenses to acquire the revenue are not growing all too fast. They are very slowly creeping up, and it kind of makes sense because they're just in a scale phase. I mean, their go-to-market strategy is very efficient. Like their sales efficiency is super high when we look at the rule of 40 and stuff like that. So yeah, boot camps are cheap. I mean, where are they spending cash? I mean, our R&D is kind of flat. I mean, yeah, they should be going up. So 18% operating margins, 21-22% net income margins, and if we can be at like high 50s adjusted free cash flow margins, that's what I'm expecting today.
All right. We got 1 minute left. Again, thank you everybody for being here. Just want to reiterate, whatever happens to the stock is whatever happens. I know a lot of you guys bought this stock well below $20 years ago, and so there's a high margin of safety. There might have been some people that just recently bought it. Earnings is always a gamble. You never know what happens. It could go up, it could go down. I think all of us are bullish. All of us are excited. Ultimately, all of us want to see the company move in the right direction. I think all three of us here could not care less if it falls 30%, it goes up 30%. We genuinely care about being long this company. But the stock is a byproduct of the company's success. And although there's a lot of external factors, we're going to see how the street reacts to it, regardless of what the street does. This has been an incredible community, incredible journey. If you're new to the channel, we ring a bell at the market close. So in about 10 seconds, if you need to mute, you can mute, but we will be closing out the market and then we will be waiting for earnings. Thank you everybody for being here. Monday, May 5th, Palantir Q1 2025 earnings. The stock market is now closed.
He made it extra long, so I had to put my headphones back on.
And now we wait. And now we wait.
So you did buy 100 shares this morning, Amit. I would like to admit, I didn't mean to say admit, but I thought it was an interesting point you brought up yesterday in your Sunday stream. That you were like, you know what? I have such a low cost basis. I haven't bought for such a long time. I was thinking the same, actually. Like, you kind of rung a bell in my head, being like, okay,
you bought some shares.
I bought 100 shares with you.
Okay,
I was like, you know what?
Oh my god!
I don't know what my at 120 something. I don't remember what my cost basis is now, but I had like a $13 cost basis before, and I was like, you know what? It's kind of like me buying back in the day. If you think about it, it's like it dilutes some of the profit that some of my other shares have had, and then also I was like, well, like what's the worst that happened? So I bought the shares at like 122 or whatever this morning when it dipped down kind of early in the morning, and immediately sold the 125 July covered call.
Okay, there you go. Not bad.
So if it goes down, I'm at a cost basis of like 106, 107. If it goes up, then I'll just have to keep rolling it, but
I think all of us know the trajectory of the business is in such a right direction that if the valuation is rich, so we know we're buying it at a rich valuation. If it comes down, it comes down. But the benefit of being here in 2022 was that it's not the worst thing in the world if you have to buy 125 if you were buying the majority at 13, right?
Although I will say, it completely destroyed my cost basis. So I just looked at it. I didn't know either way, but it was at 13.77. I think I could be wrong, 10 cents off or whatever. For my shares, I bought the 100 shares. It's now $16 is my total cost. Like it went up by like $2.50.
Oh, there
It's
you go.
insane.
But still, that's a very impressive. I
Yeah.
think so. I guess I'm the only one that bought it during like the crash we had, like with the tariffs. I think I bought at 65. I think it was. I posted on X. It was my first buy since 22. So I kind of had the same feeling as you guys. I was like, it's been a while, and at the time it was worth $65 in my valuation. I'm like, well. It's finally here. Might as well jump on the opportunity. But yeah, I've not been buying at 125, and I will not. So sorry to disappoint. I'm not joining the 100 shares at 100.
Yeah, my last purchase was $21
So
on
similar.
May 24th, 2024. So almost a year.
Yeah,
And those shares are up 488%.
Yeah.
The previous before then was November 2022. So I took, like you said, a pretty long hiatus. Those shares, anyone want to take a guess?
Those are like 13. You bought a long time, like in.
No, they're at $7. Anyone want to guess what the return is so far on those?
It's gonna be like what? That's a 14x, 15x, something like that.
1,600%.
There you go.
Wow.
It's changed people's lives. At $7, Wall Street didn't care. Retail was the only one that did, and that's why we have the ability to buy it higher because of those $7 shares. And now it's just a question of how they can continue the momentum. Guys, the earnings are not out yet. I promise I will get it to you once they are. Usually at 4:05, so I think we have about 2 minutes. So just hold tight. We should be getting the numbers very soon.
It should show on the screen, right? Like it's very quick to react.
Yeah, there's a 20% implied move here. So we're either looking at below 100 or maybe 140. I mean, it's going to be pretty aggressive here. And we just like last time, it was at 83, it gapped up to 97 and then 100, so it was pretty obvious. And so we'll see. And we will figure out how the street is reacting to it. Yeah, HIMS also has a big move right here, but we're looking at Palantir in a second.
Do you guys believe 40%? Do you guys believe 40% would be enough to keep the momentum upwards? Or
I don't know.
I
think, but I don't know because obviously the stock is.
I think so.
I mean, it's gonna beat. I mean, I would be shocked to my core if we don't beat on revenue. But it's just like by how much and what do people want? I mean, on 48%, if I'm right, I mean, I can see it pumping, even though I think it's still ridiculously overvalued. But at 48%, I don't know. I kind of expect it to go up.
It's like moving down, but it's not fully giving us a red candle. There's a red candle, down 2, down 3. All right, there's a red candle.
It's going down.
There she goes. She's down. I don't have the numbers yet.
Maybe it's on Bloomberg.
It could reverse or it could continue to go down, but it looks like numbers are officially out.
Let's make a poll. Should Amit buy a Bloomberg terminal already? He's big enough. Like, take one for the team and get one already.
AK Media can write it off, you know?
All right. I think I should be getting numbers really soon. That went down 3%. It's like it's not a real red candle until it sustains. It's kind of trying to sustain it, but it's not really sustaining it. Is it turning green? It's not really turning green either, though.
It's just minus 1% now. So fine.
I think I have the numbers. I think I should be getting it soon. Let's see. I would love to trust the chat, but I've been duped too many times by trusting the chat. So I'm going to wait till I see it on my screen. Here we go. All right. 38% growth, it looks like. 13 cents of EPS, 883 versus 862. That is 38%, 39% year over year. That's 39% year over year. 39% year over year. Stock is.
Good job, Matt. Like right on the money almost.
Pretty much almost exactly. Guess that number.
Well done.
If this goes flat and doesn't go 20% up or down, that would be quite incredible.
Still 7%. What was it? 883 what?
882. 883, no, 883.8.
0.8. That makes a difference.
We're green 2%.
Oh. I'm shocked.
I mean, 127, that's all-time highs. That's all-time highs. Can the street keep paying a premium for this company based on those numbers? Those are not bad numbers, by the way, although, we want
it's good, but
that's 39%, that's still pretty damn incredible. I'll get into more of the numbers real quick, but this is the stock right here, up 3%. It's holding on. It is holding on to some of these numbers. Let's see. if I can get the actual results. I don't have it on their website yet. Let me go to another place. It's not the implied move of 20%, but it's green. I'll take it, right?
Is that typically correct in your experience?
What?
The implied move? Like
I mean, on very high beta names, yes. But like even Robinhood had an implied volatility of 10% and it was flat on earnings. And they had a great earnings too. So it's, all right, here we go. Here's their tweet that they put out. Palantir reports Q1 2025 revenue growth of 39% year over year. US revenue growth of 55% year over year. Raised their fiscal year 2024 revenue guidance to 36%. Wow, that's up from 31%. There you go. So that went from 31 to 36. US commercial revenue guidance to 68% year over year. In Q1 2025, U.S. commercial revenue grew 71% year over year and 19% quarter over quarter. My goodness. U.S. government revenue 45% year over year and 9% quarter over quarter. Adjusted operating margin of 44%, increasing our rule of 40 to 83%. That was 81%. And they generated $370 million in adjusted free cash flow, which is a 42% margin. The stock is at all-time highs, 129.13, up 3%. I think we hit 130. For a second, we've got Karp's letter to shareholders. All right, here we go. Let's read his letter. This is going to take me a good 5 minutes, but I will be reading the whole thing, and then we will get back into the numbers. This is some pretty incredible growth. It is not bad growth at all, especially that raise from 31 to 36% for fiscal year. All right, Alex Karp. We have taken repeated and enormous risks to build this company, risks that in hindsight seem to many almost prudent and banal. To spend years constructing an artificial intelligence platform long before the market understood its value or potential applications was repeatedly derided. Many were skeptical, if not outright hostile. Early investors were skittish. Their commitment was often fleeting at best. Our results are not and will never be the ultimate measure of the value broadly defined of our business. We have grander and more idiosyncratic aims. Yet we are subtle enough students of history to understand that strength, particularly the type that makes possible the non-consensual compliance of a foreign adversary, is often and indeed, unfortunately, a essential component of forward progress. Our financial performance, that crude yardstick by which the market attempts to measure the worth in this world, continues to exceed many of our greatest expectations. We generated $884 million in revenue in the first quarter of the year, a 7% increase from the prior quarter, and a 39% increase from the same period a year before. This is a level of surging and ferocious growth that would be spectacular for a company a tenth of our size. At this scale, however, our ascent is, we believe, unparalleled. And it has been our essentially aesthetic instincts, our willingness to embrace the cultivation and nurturing of taste, in particular as a virtue in building software and constructing teams, that has propelled our rise. This breed of a company will never spring from the mind of a committee. It would have never been permitted to endure its current form, with thousands of employees organizing themselves around problems at hand, if we had submitted to the conventional managerial model in American corporate life. Stock right here is down about 3%, 121 currently right now. The rush towards large language models, as well as the foundational software architecture that is capable of making them valuable to large organizations, has turned into a stampede. What was once a relatively orderly process of assessment and evaluation of these novel technologies has evolved into a ravenous whirlwind of adoption, and an increasing number of institutions grasp the magnitude of the shift that is washing over the industry and the government. And nowhere has the change been more evident than the United States of America. Our total U.S. revenue grew 55% year over year to $628 million in the first 3 months of the year, while commercial revenue from our U.S. customers soared 71% in the same period to $255 million. Similarly, our U.S. government revenue increased 45% year over year to $373 million in the first 3 months of 2025, as our software systems for planning and executing special forces and other military operations, and for assessing and selecting targets, has been embraced by the American defense sector. These are not incremental advances. We believe our results are indicative of a revolution sweeping across business and industry. Our interest in arming the United States of America and ensuring that its defense and intelligence agencies had software capabilities that were far more lethal and precise than those of its adversaries, an aim that should be uncontroversial and nearly uninteresting, was for years dismissed as politically fraught and ill-advised. We, the heretics, this motley-based band of characters, were cast out and nearly discarded by Silicon Valley. And yet there are signs that some within this valley have now turned a corner and begun following our lead. We note that only our commitment to building software for the U.S. military, to those whom have asked to step into harm's way, remains steadfast when such a commitment is fashionable and convenient, and when it is not. The establishment consensus had in recent decades moved towards a posture of skepticism of the American project and national identity. A belief in defending the United States and its interests was cast as regressive. The logic of this recent era has been that the nation should be allowed to wither, to die a natural death, and that our primary allegiance ought to be redirected to humanity as a whole. While such an aspiration may have been noble, it has also been widely premature. Our interest in protecting those dearest to us should never have cast as standing in moral opposition to advancing and encouraging the rise of humanity at large. One will be of no use to others if he is incapable of standing for himself. The strength that we aspire to see directed at protecting those around us must first root and grow in ourselves. Saint Augustine, who was born in the 4th century of the fringe of the Roman Empire, reminds us to acknowledge and yet move beyond the central thorn in moral philosophy, rightly making the case that an abstract obligation to come to the aid of all in need not prevent us from fulfilling our obligations to those whom we are the closest. All men are to be loved equally, he wrote, but since you cannot do good to all, you are to pay special regard to those who, by the accidents of time or place or circumstance, are brought into closer connection with you. The culture of this company has always been and continues to be the precondition for the creation of our software. The company we have built is a communal endeavor, unafraid to nurture and advance a Weltanschauung. I definitely said that wrong. A community that is bound together by a short but evolving history and patterns of discourse and shared beliefs. It is that culture that allows us to encourage some 4,000 people to band together in shifting and often add amalgamations to build something of value to themselves and to the world. We are admittedly not always the most pleasant of partners. Our messaging can be too abstract or a deterrent to some. Yet the next chapter belongs not to the critics and bystanders, those at the margins of creative empires, but to those who build them. There is no question that both cultures and companies, including the ones we have built, must be built over a long period of time and be judged by their fruits. The establishment in this country is not merely adrift, as many have claimed, but has lost a sense of confidence, self-position, and internal resolve. It is not quite clear what much of the establishment even holds dear beyond its self-regard. And the learned class, our new educational and cultural aristocracy, is far more entrenched and resilient than previous nobilities whose positions were not more precarious. Nobility had nothing to explain their right and power apart from their birth. The sardonic and uncomfortable, insightful French author Michael Houellebecq said in an interview last year. Contemporary elites claim intellectual and moral superiority. The empathy for and interest in protecting the powerless and a ruthless pursuit of opportunity for all, no matter of high or low birth, that once defined a righteous and productive political movement has been set aside in favor of performative politics, whose most zealous adherents are often more interested in signaling membership in a caste that has turned off vast swaths of the public. While there is no yardstick, no willingness to measure and quantify the success or failure of a political movement or policy, and no intellectual curiosity in assessing whether an ideology or worldview has delivered for its constituents, we must be willing to expose our purported shepherds as corrupt. This argument and broader critique is set forth in the more in-depth The Technological Republic, which opens with a still timely reminder from Michael Sandel of Harvard, fundamentalists rush and where liberals fear to trend. Instead, if we fail to act to formulate an affirmative view of what technology can accomplish, the undirected logic of the market will decide for us. It will fill the chasm that is opened as a result of our contemporary skittishness to define who we are as a people and what we aspire to create. We are and always have been ready to partner with the embody of a stripe or affiliation who is willing to hold themselves accountable and quantify and measure their output. We seek partners who are interested in disposing of theater in favor of outcomes and willing to engage in a degree of forgiveness for the sins and missteps of those whose intentions are sufficiently noble. The future belongs not to those who style themselves as creators or merely to the brave, but those who actually build something substantial and lasting. The skeptics and cynics, those who doubt without putting anything at risk, and those who deride the work of others without even constructing something of their own, will be swept aside. On August 9, 1974, the day that he resigned from the presidency, Richard Nixon spoke to his staff, reminding us to never be petty. He added, always remember, others may hate you, but those who hate you don't win unless you hate them, and then you destroy yourself. Sincerely, Alex Karp, CEO of Palantir.
There it is.
Okay, cool. All right, raw reactions up here to these numbers, and then we'll keep going from there.
I'm kind of disappointed, but to be honest, I'm very much even more surprised by the stock action. I mean, I would expect a dump, but it's not yet. So can't wait for the slides to actually dig deeper into more than just these numbers, just to see what actually happened and reflect on why I was so off. And yeah, let's see. I'm kind of curious now. I kind of want the slides now, see what happened. But I mean, as you mentioned, they are good numbers. It's not bad. Like, just my expectations were really, really high. And I think, though, I assume those expectations were baked into the stock price as well, considering where it was trading. But maybe I was wrong on that too. But yeah, huge kudos to Matt. I think almost down to the dot there. So
it was a guess, but yeah, I mean, I think I want to see, because I'm also a little bit surprised why it's not maybe pulling back a little bit. Maybe the Bloomberg terminals would give us a little bit more insight, but maybe the margins are better or what have you. I don't know. I'd have to get a little bit more into the depth. So I'm kind of curious. It's hard to kind of just say with a revenue number and an EPS. what's really underlyingly good about the quarter. But something that's really been hitting home with me with respect to that letter is, and I keep hearing this. So I don't know if it's like Instagram picking up on this and it keeps showing me something similar, but it's like you would go crazy trying to make everyone understand where you're coming from, or to try to get everyone to like you, or to try to get everybody to understand. And so, it's unfortunate in this world, but I heard this from Jeff Bezos. I hear this from Palantir all the time. I hear this from so many different people, where it's just like, you know what? You're really diluting your message if you're really just trying to like dumb things down for certain people. And I see this with Palantir, and I've seen it personally over the past 6 or 7 years, where they're like, no, you guys don't understand. We need you to do it this way. It's like, no. I don't think you understand. You've been doing this the same way for the last 100 years. We are the people that understand how data flow works. We're the people that understand ontology. We're the people that really are trying to put your business into the 21st century, because you're still in 1982 and you're arguing with us about how things show up and how we should be organizing your data. But anyway, let's get to the numbers.
Can you link that, Amit?
Yeah, let me link it in the private chat. I will also say, I mean, for the amount of lives that Palantir has changed, and for people to not take 5 minutes to listen to what the CEO has to say is a bit ridiculous, in my opinion. So, I mean, he puts out a letter. I know some people might not care about it, but he's changed a lot of lives. The company's changed a lot of lives. It would behoove you to want to know what he philosophically thinks about the nature of their growth. So that's my thoughts on the letter. Yes, it was long, but I'm happy to be an investor in a company where a CEO takes the time to actually write that out. Here are the earnings results. U.S. revenue, 55% year over year, 13% quarter over quarter to $628 million. Commercial revenue, 71% year over year to $255. Government, 45%. I think that was 40% last quarter. So that is not bad. $373 million. Revenue grew 39% year over year. Again, people wanted that 40% number, 39 versus 40%. I don't think that's that big of a deal. Closed 139 deals. This was 129 deals last time, of about $1 million. 51 of 5 million, 31 of at least 10 million bucks. U.S. commercial deal value, $2.32 billion. That's up 127% year over year and 30% quarter over quarter. That's a big one that I think is going to come in handy when we look at the net dollar retention as well. Customer count, 39% year over year, 8% quarter over quarter. GAAP income, 176 million, 20% margin. That was 71 million last time. Rule of 40 went from 81 to 83. GAAP net income, 214 million. That's a 24% margin. And then they have 5.4 billion currently.
Yeah, that's a huge one. The income margin, 24%. I think it was above all three of our expectations. Well, I didn't hear Amit's expectations, but 24% is great. And surely it's because the treasury rates were still very high.
I agree. Let's get a little bit more coverage right here.
$1 million. That's up 39% year over year. U.S. leading the charge once again. U.S. government revenue growing 45% year over year to $373 million. U.S. commercial surging 71% to $255 million. Palantir closed 139 deals of at least $1 million last quarter. For guidance, the AI and data analytics company raising forecasts, all metrics above street estimates. Q2 revenue now 934 to 938 million. Expected full year revenue forecast 3.89 billion to 3.9 billion. Expected U.S. commercial revenue is also expected to grow at least 68% this year. Higher free cash flow, higher adjusted income from operations also anticipated. Now, CEO and co-founder Alex Karp telling me, quote, "This is a moment for the world to see how you actually do next generation AI implementation. Our numbers show that the revolution is real, but you need specific and very particular products and ways of doing it to capture that value." On defense spending and geopolitics, Karp telling me, quote, "There's been a lot of reforms in the DoD that have made it possible for people to enter the market besides us." Super positive on that. The defense industrial base is going to be a metaphor for manufacturing globally. So we're very optimistic about how we can help manufacturing in the U.S., where the defense industrial base, both new and older, pave the way. We see our products heavily in use there. And, America has all the advantages. We just have to take advantage of those advantages. Now, on large language model costs coming down, something we've been hearing from some CEOs, particularly on the software side, Karp explaining that, quote, "The cost of LLMs are a problem if the LLM doesn't create more value than the cost of purchasing them. The cost of purchasing them is much less currently than the cost of producing." And that's why he says none of these companies are public. But last I checked, shares of Palantir were under a little bit of pressure here.
Not anymore.
Okay, there you go. There you go. It was largely a beat and a
They are getting a little bit hit right now, down about 5% here, 118. I think one thing that we have to acknowledge here, which is, I mean, this is just, I don't think Amir and Matt are going to have any disagreement with me here on this, is that the stock pumped really aggressive going into earnings. Ironically, in Q1 of 2024, we went from 20 to 25. That was a pretty big pump, and then we fell back to 20. Here, I think over the past week, we went from like 100 to 125, you know? So it's like, this is why I spent a little bit of time before the stream started saying, hey, anything could happen to the stock. It is up pretty aggressively going into this earnings. 39% year-over-year growth is not a reason to dump, but it is a reason to dump if it pumped way too much going into earnings. And it is what it is. That's what happens. Amir, any thoughts on stock price action right now versus the numbers that we're getting?
Yeah, I think it's fine. Like, even if it goes down to like 110, I think it's still fine. Honestly, as you mentioned, like, let's not kid ourselves. Everyone knows that Palantir is trading expensive, and it has been for a while. We got that glimmer of like trading like at fair value at 65 some weeks ago, but since then it's been on a tear. So I mean, I'm completely fine with this. I'm not disappointed at all. So yeah, completely fine. Price action. I was kind of expecting like going below 100, but I mean, it's still good results so far from what we have seen. So nothing really outrageous. I mean, the dilution was 6.4%, which is less than the previous quarter. So they are slowing down. Stock-based compensation, slight increase compared to 2 quarters ago. So I mean, they're keeping stuff under control from what I'm seeing, and like nothing terrible at all. So I mean, it's a good quarter. It's just, I think a lot of people, including myself, just had so high expectations. And you shared the list that Arnie posted with all the deals that we had in Q1. Maybe we didn't extrapolate properly how long it takes before that is properly recognized. We don't really have that insight. Like, okay, they signed 50 deals, like just throwing that out there, but we don't know when they actually start to receive revenues from those deals and stuff like that. So it's a difficult company to follow, you know, and it's I think represented in the volatility of the stock as well. I mean, it's difficult, but being very rewarding as a shareholder, and they are doing great. I mean, even this far into Q2, it's looking amazing. So as for the letter, I have no comments. I'll let you guys discuss the letter.
Yeah, look, some people like the philosophy stuff, some people don't. I happen to be a fan of it. But regardless, I mean, I think these numbers are not that bad. Let's get Dan Ives and Brent Thill right here. These are two of the institutional analysts, and get their thoughts on these earnings as well.
Dan hasn't outperformed. So this is a good old-fashioned bull bear discussion here. Dan, you're on set. I'm going to start this conversation with you. Your reaction to the commentary from Karp, who basically said to me, look, macro uncertainty, if you can deliver value in this market, people are still going to spend, companies are still going to spend, governments are still going to spend, and they're seeing that in their results.
I mean, look at those numbers. I think you could print this press release off, frame it, and put it in the Louvre, because if you look at the numbers, you look at commercial, you look what, in terms of AI, they are leading when it comes to AI revolution. The software numbers are showing, even on the government side. And look, if you look at the bears, they hated 30. Despise it at 50, absolutely say it's expensive at 100, 125. Look, I believe this is going to $1 trillion market cap in the next 2 to 3 years. These numbers just show. I think it's get the popcorn out. It's still in the early days of playing out.
Brent, want to get your thoughts on this, especially since you have a price target that is markedly lower than where the stock is trading right now, basically half of where it's trading right now.
And Dan's price target's lower than his bullish view.
That's true.
Look, I think when you think about the fundamentals are alive, right? They beat by 24 million. They raised the guidance by 6 times the beat. We're not arguing the fundamentals. They are fully alive. The question becomes, there's not a single software stock that we've ever covered that trades at this multiple and sustained it. Snowflake, Datadog, you go through the list. So it's largely just history and valuation lessons, which haven't worked for any of these names. And so we watched Snowflake go to 50 times revenue and then went to 8 times revenue. And so Palantir is in a different league. There's no question the fundamentals are delivering. It's just the question, what is the stock worth? And our job is to find names where we don't feel like there's downward pressure on multiples, there's upward pressure. So Microsoft, Apple, there's a handful of other names that Jefferies covers that we're recommending that we just feel are great franchises and have better durability at multiples that aren't at 65 times revenue. There's not a single tech name that's ever sustained that multiple.
Dan, I hear what Brent is saying, but in a world where NVIDIA and Tesla have done what they've done recently, does history have that much bearing if you believe, as you seem to, that Palantir is this generational opportunity?
Well, I think, but look, I mean, the value, if you go back the last few years, right? I mean, they hated it at 10, despised it at 100, and that would be the continued argument on valuation. If you look what's happened to AI revolution, $2 trillion of spend over the next 3 years on the software side, it's their world, everyone else paying rent, and it comes Palantir. So my view is, if you look at it just on valuation, and if you went back, you've missed every transformational tech stock last 20 years. If you just focus on valuation, where is this in the next 2, 3, 4, 5 years? And I view what Karp's doing to Palantir is generational. But again, the haters are going to hate. I get it. Valuation, check the box. You look at these numbers. To me, I think this is just another sort of table pounder moment, for what I view as the Messi of AI, Palantir.
So, Brent, what breaks Palantir then in the amazing run that it's been having? Is it overall sentiment? And if it's an overall sentiment issue, how many other things have to break at the same time?
I think ultimately you hit a point which you've hit on the multiple. I mean, look at the numbers and the stock's down 5% in the after hours. If there's some break point where, investors, this has been fueled by retail. There's not a single institutional investor I talk to that even talks about this name.
And that's part of the problem.
It's a retail-driven story, and it's not being driven by institutions. Our investor base is institutions. And so the reason why I spend such little time is no one can make sense of the multiple. And so I spend my time on things that have multiple support. So again, I'm a huge fan of the fundamentals. I'm not going to argue, and I think Dan's had a great call. So kudos to him, and no one's going to take that away. It's just my view is I think there are just other stories that we have more confidence in with that valuation support.
Dan, I'm going to let you respond to this.
I'd say Brett brings a really important point, because retail has been way ahead of institutional and Palantir. And Palantir, again, they continue to hate it, and they'll continue to hate it when I believe it's up another 40, 50, 60%. Part of the problem here is that institutional, they paint it with a certain brush. They have a certain negative view. And I agree with what Brent's saying. I think institutional has been way wrong on this. Retail has been right. But I do believe institutional eventually, just given, from a weighting perspective, you can't just continue to hate what I view is going to be $1 trillion market cap.
To be fair, Alex Karp has a very negative view of institutional too.
And that hasn't helped.
Dan, Brent, thanks to you both.
Matt, I want to get your thoughts real quick, and then we'll keep going through the numbers. Just the price reaction numbers. Give me what you're thinking.
I think it's interesting. I'm just looking through. Obviously, one of the key things I always look at is buybacks. They spent about $18 million in buybacks. Just looking at the other items in here as well. Share-based compensation, $155 million. Share count slowing down in terms of the growth. So we went from 2.5 billion to basically 2.55. So nothing crazy associated with that. The things that I'm looking at, which make me super excited, is the trailing 12-month cash flow from operations being about $1.2 billion, meaning on an annual basis, we are adding $1.2 billion to that already $5.4 billion, and it's growing, right? We're not talking about it slowing down or plateauing here. We're continuing to see the growth of that. So that's promising. Price to earnings with these new numbers on a trailing 12-month basis, trailing 12-month, not forward, is over 500 still. At the current price, this was calculated a few minutes ago, so might be getting slightly better now. But at the price that it was, a $290 billion market cap at a $571 million trailing 12-month net income, you were over 500x price to earnings. So rich in that respect. But overall, I think numbers are going better than I expected in terms of margins. And I think that that's something that's necessary to look at, because you have that 80% gross margin out there that continues to shine. And with that, the thing that I'm still kind of curious about, and this is something that we've been in kind of no man's land, is basically, you're going to get above 20% net income margins eventually, right? But where do we top out, right? Is that 40%? Is it 50%? I mean, when this thing 5 years down the road is truly maturing and generating $10 billion a year, which we're on the precipice of generating $4 billion a year. So, just a quarter or two, we'll be able to grow to close to $4 billion on a trailing 12-month revenue basis. When this thing grows to $10-15 billion in revenue, where's that net income margin going to end up? And that's where I'm like really trying to understand, because you think about it, like it goes back to the conversation we were having before earnings were even released. It's like every dollar that gets put on in terms of revenue on the top line, 30 to 40 cents of that is now hitting the cash flow and the bottom line, and actually hitting into that backlog of cash that's just sitting there. And it always kind of gets back to, it's like, that's a lot of cash. What are we going to do with it, right? Are we going to ramp up these 18? We've had 3 quarters now of $18 million share repurchases. It kind of seems like a sticky number at 18 million. Is that something that we're going to ramp eventually to 50 million, 100 million? At what point do we start offsetting that share dilution? What other things? Are we going to invest $1 billion into Anduril? Like, what are the key things that you can do? And that's part of the promise, that I'm seeing here, is there's a lot of optionality with the low capital expenditure model and high cash flow. And I do want to say something. I mean, I don't disagree with Dan Ives about the $1 trillion market cap, but 2 to 3 years is a little bit ambitious. But at the end of the day, I still think this is an absolutely phenomenal company. Does it warrant a $290 billion market cap? Maybe not on a conventional basis, but it is worth $290 billion, but in what time frame, right? And I think that that's really where I'm kind of trying to understand, and where others are trying to understand. I did think it was a little interesting what Dan Ives said, and I do want to hear Amir's points as well, specifically before we jump into the actual slides, is he said that institutions aren't buying. I find it hard to believe institutions aren't buying and creating the stock price that we're seeing. I just can't fathom that it's strictly retail, considering that institutions are the one that hold the majority of the stock as it is.
Amir, your thoughts?
Well, we don't actually have all the numbers for Q1 yet, but yeah, I mean, for the last 2 reportable 13F filings, it's actually been stuck at 49%. So there might be credibility to that, actually, that institutionals are not piling in more. But yeah, I mean, it's not like some kind of seal of approval. Like, yeah, if institutionals are willing to buy it, it's a quality business. I mean, they've missed so many businesses, including Palantir. I just wanted to add the big things for me so far before we go into the slides is, as Matt mentioned, the margins. Maybe I can share my screen just quickly. I just have 2 slides I want to show.
We don't have the actual slide deck out yet either.
Okay, good. So yeah, here is actually the 13F filing. So if we look at percents of shares held by institutions, this does not include options or calls, which some websites might report. This is just the share count. It's actually been stuck at 49% for 2 quarters. But of course, the total value of their shares has been increasing a lot. Anyway, what I wanted to look at is, first of all, the operating and income margins. Actually, I thought it was a lot of interest. Revenue decreased. Actually, the big bump is from operating margins. Of course, in Q4, we had the SARS impact. But if we look at the overall trajectory, I was really looking for, as I mentioned, like if we can reach 18% operating margins, I would have been happy. We're at 20. So I'm very happy we already reached that 20% hurdle. And yeah, net income margins 25% off of that. So that's very impressive. And what I was talking about earlier, like with the dynamic and the scaling, if this is a messy chart, I just want you to look at the general direction. As you can see, like the sales and marketing is this blue line. It's going down, like only makes up 27% of revenues. general and admin also decreasing heavily. Same goes with like research and development. So they're not actually spending that much, which is pushing these margins up. And as Matt mentioned, like, where does this top out? Like, is it 40% operating margins? I believe they're moving towards 40% operating margins over time. It's probably gonna take more than this decade, if I had to guess. But yeah, I think 40% operating margins is definitely, for Palantir, maybe around, I think I forecasted it in 2031, maybe something like that. It doesn't matter. But yeah, the trajectory is very positive. I'm very happy to see 20% operating margins. That's huge, actually.
Yeah, I would agree. And look, in terms of the stock, I mean, I don't know how many ways to say it, but it got to 65, went up to 125 in less than a month. It's down 7% on earnings. Like, it happens. If it could have gone up 10%, yes. Could it go down 10%, yes. But like, to not be able to understand a stock going down after good numbers, but already after pumping 70%, to me is just it's elementary, right? Like, this stuff happens.
What do you see in Amir?
Yeah, one last slide. I just calculated the deal distribution because we got that. So, of course, a new all-time high in net new deals. And this blue line, the top line, is deals of 1 to 5 million. New all-time high at 88. And actually, 31 deals of at least 10 million compared to 32, which is the all-time high. I thought 32, like, it was a huge jump from 16 the quarter prior. So to keep in line with 32 again, like, basically all-time high of deals closed of at least 10 million, like the big deals. It could be 11, it could be 100 million, it could be 2 billion. Like, we don't actually know. To keep that so high, very impressive. The 5 to 10 million, it's down slightly, whatever. But yeah, like, these small deals are the real compounders. So all-time highs in 1 to 5 million. I expect those to over time scale up as we talked about, when they start to utilize AIP more and naturally scale their business. This is going to be a very strong cohort into the future. But yeah, new all-time high in deals, very impressive. Small deal numbers. Like, for the longest time, people were talking like, yeah, Palantir doesn't really attract these small clients, these small companies. They just sell to all these Fortune 500 companies. That narrative is gone now. Yeah, they're
it's
really
kind of proven by the 139 right? Like, just the sheer amount of deals are starting to accelerate.
Yeah, very impressive. So yeah, I mean, a lot of good stuff here. Like, I'm very happy about the margins. That's like the core thing to care about, really. Of course, revenue growth, if it's 40 or 39 or 38, like, whatever, for one quarter, the real core of, like, a quarter or two, the revenue could be like very volatile, but the core operations of the business is how you really judge the health of the business. So seeing those move up above 20% to the hurdle that I had as a goal for the quarter, I'm very satisfied with that. Like, whatever a few percentage points miss on the revenue, who cares, the core of the company is very, very healthy and increasingly so.
I would agree. Raising the guy to almost 4 billion. I mean, I would imagine they would beat and raise again for the next couple quarters. Matt, do you like that number? Do you think there's a shot? Maybe we get to that 4.2, 4.5 range for fiscal year?
Just thinking about it. I mean, what actually I'm looking at there is the Q2 guide there for 936 million in revenue and 405 from adjusted income. I think that's pretty impressive in terms of where we're kind of headed, and it just goes to show that the net income margins and the net margins just in general are continuing to be very, very, very good. So it's interesting, not that far off from what, if you think about it, what Uncle Karp was talking about. Wasn't he saying 4.5 billion by the end of 2025?
Yeah.
So the fact that we're trending towards 4, having 4 or 5 years insight, especially with a pandemic and a recession in there, yeah, I mean, pretty impressive to be able to get $4 billion and grow. I mean, we were literally on a trailing 12-month basis, fourth quarter of 2020, we exited at about 1.1 billion. So the fact that we're going to grow potentially towards 4 billion by the end of the year, very impressive.
I was called crazy so many times in my actual valuation for Palantir. I was like so overly bullish. My valuation model for 2025, my forecast is 3.8 billion. And they basically just guided for that. And we know that they typically beat their guidance. So yeah, I'm not so crazy anymore for this year.
What is crazy, not you, but the guidance quarter over quarter that they're giving now is 13%. So that's
Wow.
pretty impressive. I just looked at that. I'm just double check I'm not screwing that up. I am screwing that up. Sorry. Don't listen to me.
Yeah, I also calculated the current PE ratio. It's 545. So yeah.
Yeah, I mean, and that's the other thing. I mean, look, I know people are going to be emotional on the stock, but it's one of those things where if you've just joined the Palantir community, I'm sure there's many of you, maybe you bought at 100 and you're upset. If you've been here for a long time, this is just not something you can be upset about. I mean, all right, you're not up 15x, you're up 12x now. You know, it's like it's one of those things where is the business functioning in the right way? And if it is, which based on all the numbers I'm looking at, we don't have the full deck yet, but just on these top line numbers, they're pretty damn incredible, especially from a margin perspective. The answer is yes. And I think that's only going to inflect further and further.
Yeah, I mean, as Karp mentioned last quarter, like renaming the rule of 40 to the rule of 80. I mean, if they can be consistent about that, then yeah, they're going to grow pretty quickly into these multiples. Like I personally, I don't care about multiples. I just do an intrinsic valuation on the business. So I never paid much attention to that, but it's so funny to listen to, was it Brent Dill? The analyst? Yeah, he's always been shouting about the multiples, even though the multiple is very high now. I think he jumped from like $28 fair value to like 68.
And this is
the argument is
this is an important point. These guys don't actually care about the multiples. They care about the stock price, because once the stock's at 100, you can't have a $28 price target. So now let's take up the multiple. Well, what justifies 28 to 68? Nothing other than sentiment, right? So when they accuse retail of being so sentiment driven, it's like their entire life is based on increasing a multiple because the stock got out of hand.
Yeah, and I forget now just in the heat of the moment, but one similar analyst was replaced because he missed the Palantir story because he was just too focused on the multiple. So I think it was Morgan Stanley. They just replaced their analyst. They're like, no, you don't get this. They brought in a new guy, raised the price target. I mean, yeah, like they just don't get it yet, which is kind of bullish actually. As Danais was mentioning, like, yeah, you guys not getting it is pretty bullish. Now, as he did, to be fair, mention that he sees nothing wrong with the company, the business itself. He's just too focused on the multiple. But I think if they had an intrinsic valuation approach, they might have not have missed Palantir, to be honest.
Sorry, go ahead.
I was just going to say real quick on HIMS. I don't look at all the numbers, but I think they put 111% growth. Their stock is up 2%. That's nice, but I think people are expecting 20%. It just goes to show you HIMS also pumped a lot, 60% from the lows going into your earnings. And sometimes when you pump that heavy into earnings, you could have really good numbers, but you just might not get a further continuation of the premium on the stock.
A key metric that I'm missing. Did you happen to see NDR? Amir?
No, it's in the slide, so we have to wait. Also, we don't have actually the commercial and government revenue, so we can't really see like how international did, because the only thing I'm bearish about is international commercial. It's been so weak. They mention it like every earnings call since they went public that, yeah, Europe is not playing ball. So I'm really curious about international commercial specifically. Now, we know about the NATO deal for Q2 and the international government. So that's obviously going to pick up and be huge for Palantir. But I'm really curious about the commercial side. But yeah, we have to wait to get government and commercial numbers separated to actually see some calculations. And net dollar retention will be in the slides, hopefully.
Yeah. I'm not going crazy. I feel like they always provide the slides half hour after close.
Yeah, it's not out. It's weird. It should be out by now.
Yeah, because well, now Palantir is a bit different, but it's kind of important to have some more information before the call, right? So that the analyst can actually ask some questions. Now for Palantir, they don't typically have a lot of analysts on the call. So
Amit, are you gonna have a secret
are you gonna
question?
pick up the phone? Are you gonna pick up the phone?
I'm not. It's not going to be. It's probably going to be Mariana and Dan, as always.
Is Dan gonna be like walking around his kitchen again? Can we take a bet on that?
Yeah.
Dan,
Okay. Hot take. Well, it's not that hot. Dan Ives, how are boot camp conversions? What's the conversion rate? Every single time.
I don't even. We don't even talk that much about boot camps anymore. I feel like that's just part of.
Yeah, it's just like ingrained now. Yeah.
Yeah.
Not that hype anymore.
Also, I mean, stocks at 117 versus 125, there's not that much of a difference in terms of how expensive it is. Even at 95, it's still pretty damn expensive. So the fact that it's holding up right here, I think, is also rather impressive. But tomorrow's going to be the real test at 9:30 when it opens, and we see, do people dump or do they buy the dip here?
I was gonna call this out earlier when Matt joined and had his opening statement. He mentioned like the parallel to like Palantir becoming the second most important company after Microsoft as an example. And Dan Ives, I've been so upset with him because he keeps saying Palantir is the next Salesforce. I'm like, what are you talking? Salesforce wishes it was Palantir. Like, what are you talking about? What do you mean the next Salesforce? Yeah, like Microsoft is the real one to have in the conversation, and not like Dan Ives talking about Salesforce.
Yeah, pretty much building your entire enterprise on Palantir is the goal, not necessarily the Salesforce piece. I agree with you there.
Yeah, and I think I made some comment on X because I think last week Palantir surpassed Salesforce in market cap. I was tagging Dan Ives and he liked the tweet. I'm like, what are you talking about, dude?
Well, let me ask this question, going back off what Dan and Brent were talking about. I got Matt's opinion, but Amir, do you think this is primarily retail driven, like largely, or how do you think this stock is getting to these multiples right here?
I'm so bad with charts and stuff and movement, but I mean the numbers are saying the ones we have are not saying that institutionals are increasing all that much. So we'll see when the Q1 13Fs start piling in and get complete. But so far, from the firms that have reported, I'm not seeing like a huge increase. So I think there's going to be around 50% for Q1 as well. So I think it's retail mainly.
Well, at that point, it's 50-50 then. It's not like it's not like 70-30 like it was for Tesla 5 years ago.
Yeah. It's been about 50-50 for 2 quarters. I expect that to be 3 quarters basically. But yeah, I think it's mainly retail, and I'm completely fine with that. I don't get too hung up. Like Peter Lynch famously wrote that you typically want to get into stocks that don't have a lot of institutional ownership, and the core argument I hear now, you guys might disagree, but my take is that people who want a lot of institutional ownership, they typically mention that it's because it's going to be less volatile. But yeah, I never see the evidence of that really, so I don't care either or. So yeah, I'm fine with either.
Yeah, I would agree. We got about 10 minutes until the call starts. Real quick, just looking at HIM's numbers now that we have some time for it. This one is up 0.64% after hours. 42.21 is what I'm looking at. They, I think, had a little bit light of a guide, which is why it's not like mooning like some people thought. 33% still short. Revenue was a big beat. 9%, 586 versus 538, and then EPS 20 cents versus 12 cents, beat by 67% on EPS. EPS is up 300% year over year. Revenue is up 111% year over year.
Wow, 67% on EPS. Aren't you getting into this stock, Amit? I read something like that.
I am looking at it. I don't have a position. I know a lot of people want me to buy this, but I've barely started my DD. But the growth is pretty incredible from what I'm looking at. So
yeah, I'd like to follow my sword on this one. So I remember looking at this back in 20, or maybe it was early 24 or late 23, mid 23. And I was afraid of how much money they were putting into marketing. And so my fear was that they were artificially inflating their subscription revenues based off the fact that they were just pumping money into marketing. And so marketing as a percentage of their revenue was a huge percentage. And my fear was as well, if you ever start to pull back on marketing to be able to grow, net margins, then obviously your sales are going to fall off. But little did I know, their retention rate of their business has been absolutely stellar. And so with that, they've been able to continue. Unlike the reason why is because I got burnt before buying Wish. And that was a comparable sort of thing, right? Lower quality sort of things directly out of China, bad customer service. People were getting things in 30, 40 days, not necessarily good. And that was all pumped up by marketing as well. But when it comes to HIMS, they kind of proved me wrong. And it goes to show you that you really need to think about things sometimes and not get over biased. But also learn from your mistakes as well. Like, it could have also been that way, but this is another thing to show you that, like, yes, just because somebody pumps marketing budget doesn't necessarily mean it's bad. You have to look at other things. So anyway, I just want to admit to people that I got, I could have bought HIMS when Chris and many others were kind of, talking about it in the low single digits. And unfortunately, I said, you know what, I'm afraid of it. I'm going to stay away from it for now. But I agree. I think it's something that you could still look at. And actually, I've been talking about it with Tevis, and I might actually look at it as well.
Well, we got someone in the background who's an OG Palantir member. Let's get his thoughts on earnings. We got 7 minutes until the call starts.
Yeah.
Hey, guys.
Looking
Hey,
good, dude.
Dom. It's been a while,
How
man.
you doing? It's been a long while, man. Life has been crazy. But
I like that shirt, dude.
Thank you. I'm always watching you guys, always following, and I would agree with all the things you said. I mean, I'm thrilled with these results. They definitely executed on all the things that they said they were going to do, and then some.
Dom, I mean, you saw the results. We're looking at it right here on the screen. Obviously, the stock is down about 5-6%. I mean, how are you reconciling the stock versus the numbers, and how are you thinking about it?
Yeah, I mean, I think everyone here, we're all holding this for 5, 10 plus more years, if not longer. So I'm, like you said earlier, focusing on the business, right? So the stock, it's going to pull back. It's going to go up. I bought shares at 125 because I didn't know if they put up numbers like this. I thought maybe, who knows, maybe we go to 150. I mean, it's so unpredictable. But whether I'm getting it at 125 or, 100, I still think this is a $1 trillion market cap company. So we just got to grow into it, right? So dollar cost average. Everyone at my new job, they all know about Palantir.
I love it. Top line revenue, 39% year over year. Dom, did you expect them getting close to 40% or?
No. I mean, some of the goals that they set up there, and they said, because I was looking at what they were quoting they were going to do. And then I was like, I had to do the math there. And I was like, are they sure they're going to be able to do that? So, and we didn't even see a lot of big commercial announcements either, right? Like we saw a lot of government announcements and Doge and ICE and NATO. But, I went back and looked at last quarter, and it said that they had 450 AIP enterprises running AIP right now. That doesn't mean that all of those are converted to sales yet. So, and they're all doing this with a flat employee count. So, it's very impressive. It's very impressive.
Yeah, I would agree. 116 right here on Palantir, down about 6%. Dom, when's the last time you really bought this thing? Was it in the 70s, 80s, or? I
bought a lot in the 70s and 80s, but I mean, I even bought some at 125, bought some at 110. I know that regardless, I think this is 4Xing in 5 to 6 years, and I'm okay with that. I already made my big jumps from what it went before. And then I'm still trying to add my Tesla position because I still think that's probably one of the more underappreciated ones in the industry today, long term.
Yeah. We got the call in about 4 minutes. There is this thing that Dan Ives said, which was $1 trillion. Amir, do you think Palantir becomes $1 trillion company one day?
Yeah, one day. I just don't
one
know
day. We're not going to put a timeline.
Yeah, just don't know the timeline. But I have to say, it is wild. We have 4 minutes to go. There's no slide deck out. It's crazy.
Yeah, that is weird. Usually we get it by now.
Yeah, what do the cool kids say? He had me in the first half, not gonna lie. Like he was like, it's gonna be $1 trillion company. I was like, yes, it will be $1 trillion. He's like, in the next 2 to 3 years. I was like, oh god. No.
I think Dan is a little aggressive with his timelines.
You know, I was so surprised because during this huge tariff downtrend, he cut one of his two biggest like success stories, which is Tesla and Palantir, of course. He cut Tesla. He did not touch Palantir's price target. So that was also very impressive. Even when Palantir was like at 65, typically these analysts, they adjust their price target given like what the stock is doing. So yeah, I was very surprised to see that he held fast on his Palantir price target. And he did it for Tesla, which he probably loves just as much, if not more, than Palantir.
Just think about this part. We haven't even seen any new product announcements in a while. So, you know, I don't put it past them to be able to have new things down the pipe that they know are coming, that you can't put a financial model on, right? I trust him just like I trust Jensen and Elon when they say, you don't even know what you need here in the next 5 years, but we're building it. You know, I mean, there's few CEOs like this that really have a grip on where the industry is going. So I think we still have so much more room to grow.
I've been
was
like
the warp speed two quarters ago? Warp speed feels kind of new still, maybe.
Yeah, it was about yeah. I guess when I think of new product, I think of the commercial side that we get to get more coverage on. But yeah.
For the last 10 minutes or so, I've been thinking, like, are they intentionally not putting out the investor deck because they have some announcement or something within that they don't want to?
Oh.
But that I'm like, that's speculation, right? I honestly have no idea. It could just be like
you never know. You never know with Palantir.
You don't. And emerging technologies like this, I mean, it's hard to predict stuff. It's the AI movement's moving so fast.
Yeah, I thought there might just be a technical issue with why the deck's not up, but
I mean, even the letter is not up, so you guys got it by like hacking the link. I'm assuming by just changing the quarter, but like even the letter isn't on the site.
Well, on Twitter they posted the link to the letter. That's how I got it.
Oh, okay. But if it's not on the site, so that's strange.
Yeah. All right, call should be starting in about 30 seconds. We're gonna be listening to them. It's about 30 minutes of financials, and then after that, it's about Q&A and Karp talking with Sham and Glazer and Ryan Taylor and all those guys. So we'll be back probably after an hour to analyze it, and then we will keep going from there. Stock right here at 115.96, down about 6.71%. Currently right now. Some things that they might talk about: Doge, they got a big NATO contract, obviously commercial growth, raising guidance, 39% year over year, 36% fiscal year. That's up 5% from their previous guidance. So there might be a variety of things that we see them discuss on this call. All right, here we go.
Team, and I'd like to welcome you to our first quarter 2025 earnings call. We'll be discussing the results announced in our press release issued after the market close and posted on our investor relations website. During the call, we will make statements regarding our business that may be considered forward-looking within applicable securities laws, including statements regarding our second quarter and fiscal 2025 results, management's expectations for our future financial and operational performance, and other statements regarding our plans, prospects, and expectations. These statements are not promises or guarantees and are subject to risks and uncertainties, which could cause them to differ materially from actual results. Information concerning those risks is available in our earnings press release distributed after the market closed today and in our SEC filings. We undertake no obligation to update forward-looking statements except as required by law. Further, during the course of today's call, we will refer to certain adjusted financial measures. These non-GAAP financial measures should be considered in addition to, not as a substitute for or in isolation from, GAAP measures. Additional information about these non-GAAP measures, including reconciliation of non-GAAP to comparable GAAP measures, is included in our press release and investor presentation provided today. Our press release, investor presentation, and other earnings materials are available on our investor relations website at investors.palantir.com. Over the course of the call, we will refer to various growth rates when discussing our business. These rates reflect year-over-year comparisons unless otherwise stated. Joining me on today's call are Alex Karp, Chief Executive Officer, Shyam Sankar, Chief Technology Officer, Dave Glazer, Chief Financial Officer, and Ryan Taylor, Chief Revenue Officer and Chief Legal Officer. I'll now turn it over to Ryan to start the call.
Our first quarter of the year showcased incredible strength and remarkable momentum as revenue grew 39% year over year. Our story continues to be one of preeminence in the US. Our US revenue grew 55% year over year and now makes up 71% of our overall business. Our US commercial business's extraordinary momentum continued as revenue grew 71% year over year. Our foundational US government business achieved compelling revenue growth of 45% year over year. Our results continue to redefine the Rule of 40, with our Rule of 40 score increasing from 81 in Q4 to 83 last quarter. While organizations may consider curtailing spending to drive efficiencies or weather heightened volatility, they find this is the moment they need Palantir the most, the time they turn to us asking, how can we help them adapt and solve their latest challenges? As AI models progress and improve, we continue enabling our customers to maximally leverage these models in production, capitalizing upon the rich context within the enterprise through the ontology. We remain differentiated in our elite execution to deliver quantified exceptionalism for our customers, ever widening their advantage over the AI have-nots. As a result, unrelenting demand for AIP continues to drive outperformance despite Q1 historically being our slowest quarter due to business seasonality. Our US commercial revenue grew 19% sequentially to surpass the $1 billion annual run rate for revenue in Q1. We closed $810 million in US commercial TCV with a 239% year-over-year growth rate on dollar-weighted duration basis. And we closed twice as many deals of $1 million or more compared to the same time period a year ago. I feel the demand in the conversations I'm having with customers. On the ground, things are accelerating. Customers are getting started, then expanding in quick succession. A large healthcare company did a boot camp with us in December and 5 weeks later converted to a 5-year, $26 million ACV enterprise agreement. A global bank started a pilot with us in Q4 2024, signed a $2 million engagement a month later, then expanded to a 3-year, $19 million ACV engagement 4 months after that. A Fortune 500 healthcare company began working with us in Q2 2024, and last quarter signed a 5-year, $10 million ACV conversion deal. The pace and magnitude of these deals are being driven by the quantified exceptionalism our customers see from day one working with us. We continue to hear from customers that our software's impact is remarkably apparent. A Walgreens executive recently highlighted Foundry and AIP allowed them to deploy AI-powered end-to-end workflows in 4,000 stores within 8 months, automating what would have amounted to 384 billion decisions every day if relying on humans. AIG recently highlighted that they expect the end-to-end adoption of tech advancements leveraging Palantir will double their 5-year CAGR. They noted, quote, "It's an unbelievable outcome in terms of what we get. You could give underwriters unlimited time, 2, 3, 4 weeks. They still can't get the amount of data that I can get within 2 to 3 hours through Palantir." We are partnering with R1 RCM to develop intelligent automation solutions to create faster, more precise healthcare reimbursement outcomes. Their executive noted, quote, "We believe there's a multi-$100 billion opportunity here industry-wide to put money back into the pockets of providers and physicians so they can better invest in patient outcomes." Our name is popping up across earnings calls around the world as companies like Citibank, BP, and L3Harris tout the ambition of their work with Palantir to their investors. Our US government business continues to achieve impressive growth as we deliver towards the vital missions of the agencies we support. As the government focuses on efficiency, our commercially fielded, battle-hardened products stand alone. Last quarter, we closed deals expanding our work in the Department of Defense, including the critical impact we are delivering with Maven Smart System across the COCOMs and the services. The impact is far-reaching. Internationally, we closed a deal to provide Palantir Maven Smart System to NATO to deploy our AI mission command solution across its 32 member states. Historically, in periods of turmoil, organizations, both public and private, have turned to Palantir. With the proliferation of AI, you see an even wider gap between the winners and losers. The winners won't be determined by size, but by adaptability. Many organizations are having to reimagine how their business does and should work in the future, simply to survive. We are built to help companies embrace volatility. We expect more surprises, not less. And with the uncertainty ahead, we are more confident than ever in Palantir's ability to deliver tangible impact for our customers, to transform organizations with real workflows in production, and to help institutions adapt to survive. I'll now turn it over to Shyam.
Thanks, Ryan. We've been consistently saying that even while the LLMs are improving, the models, across both closed and open source, they're becoming more similar, and that performance will converge, all while cost per token for inference continues to drop substantially. The market has been focused on AI supply, the models, while we have been focused on delivering on AI demand. It's now blindingly obvious to everyone after the first DeepSeek moment. Our foundational investments in ontology and infrastructure have positioned us to uniquely deliver on AI demand now and into the world ahead. AIP has entered the next phase of product development and adoption focused on enterprise autonomy. As I mentioned last call, the normative value of AI is the self-driving company. We're not talking about co-pilots that make you 50% more productive. We're talking about agents that make you 50 times more productive. AIP is increasingly owning the position of being the technology that translate the ever-expanding raw capability of LLMs into business outcomes through ontology. AIP is proving to be the best harness to build, test, evaluate, and deploy agents to eat the elephant of the enterprise. Everyday users are building their own agents to realize the potential of enterprise autonomy across both public and private sector. AI agents are operating as part of human AI teams, leveraging the mix of workflow applications for mammals and code-first approaches for AI agents, with ontology as that common intermediary representation of the state of the enterprise. Agents are having a transformative impact for our customers now, from targeting our enemies to targeting supply chain opportunities. You can hear more about these stories, not in our earnings call, but as Ryan mentioned, in our customers' earnings calls. AIG, Citi, BP, L3 Harris, Hertz all mentioned the transformative impact of AIP on their most recent calls. These agents represent AI users, the supply chain agent that works with your supply chain analysts, the intelligence AI agent that works with your human agents. AIP as a platform enables our customers to rapidly build and deploy AI agents that automate more and more of the enterprise in a continuous fashion. AIG announced the AI underwriting agent. AI agents are processing vast volumes of intelligence reports in the Department of Defense, finding things humans missed. AI agents are monitoring for sepsis at Tampa General. As Ryan mentioned, our US business is on fire, and I want to again call out the continued strength with Warp Speed in particular, our modern American manufacturing operating system. Both the adoption and the rate of product development has exceeded expectations. These investments are powering America's reindustrialization, not only with new defense entrants, but also with traditional defense industrial players and the broader manufacturing industry. Turning to government, we delivered our first Titan vehicles to the US Army in Q1, on time, on budget. The Army rated the Titan as a top-performing program. And everything about it is heretical, a military vehicle with a software company as the prime contractor. And it's built by a team of non-traditional defense innovators like Anduril. Maven Smart System adoption continues to grow, with usage doubling in the first 9 months of 2024 and doubling again in the 5 subsequent months. The rate of adoption has really accelerated as Maven scales across more combatant commands and through the services and into more and more use cases. You commonly hear combatant commanders reference Maven in their posture hearings to Congress now. And Maven has reached Europe, with NATO adopting the capabilities of Maven Smart System as its C2 operating system. Leadership at EUCOM said this platform, Maven, has become more than a common operating picture. It's a decision advantage environment that is rapidly transforming the command. AI agents aren't just transforming the US commercial sector, they are transforming how we fight. AI agents are analyzing intelligence, finding targets, automating staff functions, and improving the understanding of the battle space. But we are just at the beginning. Our defense users are amongst the most creative and self-sufficient developers. Green suiters developed the Hurricane Helene Rescue Common Operating Picture in 5 days. Next time, they will have AI agents do it for them in 5 minutes. With that, I'll turn it over to Dave to take us through the numbers.
Thanks, Shyam. We had an exceptional first quarter. Revenue growth accelerated to 39% year over year, exceeding the high end of our prior guidance by nearly 350 basis points and representing a 1,800 basis point increase compared to the growth rate in Q1 of last year. We achieved another billion-dollar milestone this quarter by surpassing $1 billion annual run rate in our U.S. commercial business for the first time, which grew 71% year over year and 19% sequentially. On the back of this continued strength, we're raising our full year 2025 revenue guidance midpoint to $3.896 billion, representing a 36% year-over-year growth rate, and our U.S. commercial revenue guidance to an excess of $1.178 billion, representing a growth rate of at least 68%. The continued increase in demand for AIP drove the outperformance in our U.S. business overall in the first quarter, which grew 55% year over year and 13% sequentially, including our U.S. government business, which grew 45% year over year and 9% sequentially. We delivered these outstanding top-line results at an adjusted operating margin of 44%, representing an 800 basis point increase compared to the first quarter of last year. Our revenue and profitability drove a 2-point sequential increase to our Rule of 40 score from 81 in the fourth quarter of 2024 to 83 in the first quarter of 2025. We also had a strong cash flow quarter with adjusted free cash flow of $370 million, representing a margin of 42%. Turning to our global top-line results. First quarter revenue grew 39% year over year and 7% sequentially to $884 million. First quarter U.S. revenue grew 55% year over year and 13% sequentially to $628 million. Excluding the impact of revenue from strategic commercial contracts, first quarter revenue grew 44% year over year and 7% sequentially, and first quarter U.S. revenue grew 56% year over year and 14% sequentially. Customer count grew 39% year over year and 8% sequentially to 769 customers. Revenue from our largest customers continues to expand. First quarter trailing 12-month revenue from our top 20 customers increased 26% year over year to $70 million per customer. Now moving to our commercial segment. First quarter commercial revenue grew 33% year over year and 7% sequentially to $397 million. Excluding the impact from strategic commercial contracts, first quarter commercial revenue grew 42% year over year and 8% sequentially. We closed $930 million in commercial TCV bookings, representing 84% growth year over year. As I highlighted earlier, we achieved a $1 billion annual run rate in our U.S. commercial business for the first time, as AIP continues to drive both new customer conversions and existing customer expansions in the U.S. First quarter U.S. commercial revenue grew 71% year over year and 19% sequentially to $255 million. Excluding revenue from strategic commercial contracts, first quarter U.S. commercial revenue grew 75% year over year and 22% sequentially. We had the strongest quarter of U.S. commercial TCV booked at $810 million, representing growth of 183% year over year. On a trailing 12-month basis, we closed over $2 billion of U.S. commercial TCV bookings, highlighting the demand for AI production use cases. Total remaining deal value in our U.S. commercial business grew 127% year over year and 30% sequentially. Our U.S. commercial customer count grew to 432 customers, reflecting growth of 65% year over year and 13% sequentially. First quarter international commercial revenue declined 5% year over year and 11% sequentially to $141 million. The decline was driven by continued headwinds in Europe and by the one-time revenue catch-up in the fourth quarter of 2024 that we noted on last quarter's call. For our international commercial business, we continue to capitalize on targeted growth opportunities in Asia, the Middle East, and beyond, but remain focused on accelerating the growth in our U.S. business. Revenue from strategic commercial contracts was $5.1 million for the quarter. We anticipate second quarter 2025 revenue from these contracts to be between $4 to $6 million compared to $9 million in the second quarter of 2024. We anticipate 2025 revenue from these contracts to continue to be approximately 0.5% of full year revenue. Shifting to our government segment. First quarter government revenue grew 45% year over year and 7% sequentially to $487 million. First quarter U.S. government revenue grew 45% year over year and 9% sequentially to $373 million. This growth was driven by continued execution in existing programs and new awards reflecting the growing demand for AI in our government software offerings. First quarter international government revenue grew 45% year over year and 2% sequentially to $114 million, bolstered by our continued work in UK healthcare and defense, as well as our new partnership with NATO. First quarter TCV booked was $1.5 billion, up 66% year over year. Net dollar retention was 124%, an increase of 400 basis points from last quarter. The increase was driven both by expansions at existing customers and new customers acquired in Q1 of last year as we see the effect of the AI revolution. As net dollar retention does not include revenue from new customers that were acquired in the past 12 months, it does not yet fully capture the acceleration and velocity in our US business over the past year. We ended the first quarter with $5.97 billion in total remaining deal value, an increase of 45% year over year and 10% sequentially, and $1.9 billion in remaining performance obligations, an increase of 46% year over year and 10% sequentially. As a reminder, RPO is primarily comprised of our commercial business, as it does not take into account contracts with an initial term of less than 12 months and contractual obligations that fall beyond termination for convenience clauses, both of which are common in most of our government business. Turning to margin and expense, adjusted gross margin, which excludes stock-based compensation expense, was 82% for the quarter. Adjusted income from operations, which excludes stock-based compensation expense and related employer payroll taxes, was $391 million, representing adjusted operating margin of 44%. Q1 adjusted expense was $493 million, up 8% sequentially and 21% year over year, primarily driven by our continued investment in AIP and technical hiring. We continue to expect to see a more significant increase in expense in 2025 as we invest in the most elite technical talent, the product pipeline, and AI production use cases, all while delivering on our goals of sustained GAAP profitability. First quarter GAAP operating income was $176 million, representing a 20% margin. First quarter GAAP net income was $214 million, representing a 24% margin. First quarter stock-based compensation expense was $155 million, and employer-related equity tax expense was $59 million. First quarter GAAP earnings per share was 8 cents. First quarter adjusted earnings per share was 13 cents. Additionally, our combined revenue growth and adjusted operating margin accelerated to 83% in the first quarter, a 2-point increase to our Rule of 40 score from the prior quarter and our 7th consecutive quarter of an expanding Rule of 40 score. With the increase in our 2025 revenue and adjusted operating income guidance, we are now guiding to a Rule of 40 score of 80 for the full year. Turning to our cash flow. In the first quarter, we generated $310 million in cash from operations and $370 million in adjusted free cash flow, representing margins of 35% and 42%, respectively. Through the end of the first quarter, we repurchased approximately 2.3 million shares as part of our share repurchase program. As of the end of the quarter, we have $918 million remaining of the original authorization. We ended the quarter with $5.4 billion in cash, cash equivalents, and short-term U.S. Treasury securities. Now turning to our outlook. For Q2 2025, we expect revenue of between $934 and $938 million, adjusted income from operations of between $401 and $405 million. For full year 2025, we are raising our revenue guidance to between $3.89 and $3.902 billion. We are raising our U.S. commercial revenue guidance to an excess of $1.178 billion, representing a growth rate of at least 68%. We are raising our adjusted income from operations guidance to between $1.711 and $1.723 billion. We are raising our adjusted free cash flow guidance to between $1.6 and $1.8 billion, and we continue to expect GAAP operating income and net income in each quarter of this year. With that, I'll turn it over to Alex for a few remarks, and then Anna will kick off the Q&A.
Welcome to our earnings adventure. Palantir is on fire. There's been a lot of discussions, basically, how we should talk about these numbers and people admonishing me to be a little more modest. And we'll try. The reality of what's going on is that this is a unvarnished cacophony of the combination of 20 years of investment and a massive cultural shift in the U.S., which is generating numbers, again, 71% growth in U.S. commercial, 71%. We had journalists this morning that were asking me if it's a 7 handle. 71% growth. We had 45% growth in our U.S. government business. Every 3 days, you read a headline about how our commercial business would be in danger because of pressure, necessary pressure put on the system to root out fraud, waste, and abuse, and to pen test systems to see if they create more value or much more value or less value or no value in the U.S. government. We are seeing rapid expansion and very significant demand for Maven, both in America and outside of America, as all part of our core mission to provide an unfair advantage to the noble warriors of the West. We see an increased recognition that large language models were commodities, that the value of these commodities becomes only realizable in the context of our ontology on top of Foundry. As has been mentioned, the reindustrialization of America is happening in our software. The ability to reimagine your business in a volatile situation happens in our software. If you take the 90% of our business that is outside of Europe, which is going through very structural change and doesn't quite get AI, maybe in the near future will get AI, we are hoping and praying. That part of our business grew 49%. 49%. And we're doing this at a very significant scale. So we're saying we're going to do close to $4 billion in revenue. And last, not least, we're doing this with double the gold standard on the Rule of 40. The Rule of 40 is a very important standard because it shows you the quality of your revenue and because it's hard to attain, especially if you have a Rule of 83. And you know, one of the things that Palantir is doing is we want to bring our friends and our allies along with us on this winning ride. Those friends are largely in America, but also among allied countries. Those friends are inside Palantir, outside Palantir, and we are using ontology and AI or AIP to drive these successes. And I would say, well, you know, profitability is apparently, you know, unpopular. The numbers are driven by the fact that we are downstream from value creation. There's a consensus in the market that Palantir owns value creation. And what does that actually mean? It means that when you use our software, when you use AIP, you will get demonstrably more value than what you're paying for, and you will share some of that value with us. And then I would say also, culturally, we just don't see the resistance to the way we roll that we did in the past. We would show up in the past, the freak show, trying to get things to work, not with the wrong access to the wrong people at the wrong time. And that was by intent. And people were very uncomfortable at all levels of the enterprise working with us. And without going into specific names, because, you know, these companies in many cases, you know, are in the middle of transforming themselves, but I'm on the front line with everyone here. And it used to be 2 years ago that we might get a CEO, we might get a CIO, we might get someone in marketing, we might get someone who's willing to rebuild the business, but they had no power. Now we have the full stack engaged with us, inside government, outside government, on the most critical issues. And if you look at the math in terms of where the action is, our business is growing 49%, ex-continental Europe, 49%, Rule of 83. We were the freak show. And we spent 20 years for this moment, and we plan to have nose to the grindstone, focus on taking the best talent inside Palantir, managing them, the best clients, and make sure our clients and our partners, especially in national security, but also with a pretty significant focus on the U.S., win in the way we're winning. And that's why you get these results. And we're going to just focus and focus and focus and focus on execution. And that's basically our plan for the rest of the year and into next year. And we're very, very optimistic about what's going on. And with that, we can kick it off to questions.
Thanks, Alex. We'll now turn to a few questions from our shareholders before opening up the call. Our first question is from Gabriel, who asks, how does Palantir plan to sustain its competitive advantage in AI, particularly in light of growing competition?
Thanks, Gabriel. Well, our advantage comes down to ontology. It's really an advantage on the AI demand side. And that has positioned AIP to be the platform that is able to capture the ever-expanding capability of the raw LLMs and turn that into business value. AIP is that tool factory and the point of control for the orchestration with these models and those tools. You can see this in the sharp opinionation that we've earned in the field with our customers and how to get to value in days or weeks. And most critically, you can see it in the insight that we have that to practically transform the enterprise, you actually need mixed human AI teams. And that is something that AIP is uniquely positioned for.
Thank you, Shyam. We also received a few questions on this topic. How will the current U.S. administration's focus on reducing federal spend, as well as the February announcement of U.S. Department of Defense budget cuts, impact current contracts as well as future contract acquisition?
Well, the first thing I'd say is, like, this is the right thing for the country. Like, we have way too much spend on things that do not work. The government has started to resemble a finely marbled Wagyu. The fake projects that do not deliver and will never deliver crowd out and suffocate the things that could actually be excellent. And so we welcome Doge. I mean, to me, these guys are heroes. They are world-class technologists that could be choosing to do anything. And instead, they are choosing to do this. And we believe deeply in the actual value that our software is creating, both on an absolute basis and on a relative basis to the traditional labor-based cost-plus model that has failed to deliver for the American people.
We often get variants of if the institutions are in pressure, either we go through a difficult time in America or there's Doge, how will that affect your software sales, basically? And Palantir does exceptionally well when things are pen tested. We like pressure on the system. We need pressure on the system. And then why is it better for America? Because that pen testing forces you to ask questions like, does the software work? How does it work? How does it manage ethical concerns? How does it manage data protection? How does it manage output? Without pressure on the system, one of the myths is that if you don't have pressure on the system, you just spend money, you somehow get a better system, both in terms of output and in terms of ethics. But actually, you get neither. And so in reality, we need pressure on the system. We need people to have to change. We need people to have to transform. This is why they put up with us. And once they see those results, they stick with us.
Thank you both. Our next question is from Dan with Wedbush. Dan, please turn on your camera and then you'll receive a prompt to unmute your line.
Thanks, and another amazing quarter. I mean, so my question is, given what we're seeing in the government, isn't that another opportunity where you could actually gain more share of budgets as you go to more meritocracy? Like, Palantir should actually gain more dollars within the budgets of DoD and a lot of other agencies.
We're very optimistic about what we're going to do in the U.S., but the devil's in the details. And we're running this business for you, with you as owners, which means it's like there's going to be maybe lumpiness, but we predict we're going to do very, very well. Basically, where you have pressure testing, you can assume AIP, AI Foundry, Ontology, Apollo, and the Palantir culture itself. I mean, we are a warrior culture. Like, that's why our whole culture is built around putting the exact right team and the exact right product at the final mile. And so where you have environments that are crucial and under pressure, you can expect, and where meritocracy happens. It's like, we need meritocracy. How do you get meritocracy? Well, there's lots of ways to get meritocracy. One way is because you're scared. And then you buy the best product, you install the best product, and then the part that's or correlated different than people think is you also get the best ethics, the best execution, and that, of course, and then you can ask a simple question. Why is this a moat? Okay, well, I can tell you why it's a moat, because heretofore, no one has gotten into these environments at scale under any circumstance. And if they did get in, they got in with services. So now we have a single purposed, highly formed stack of software that is exactly right for this moment, with a culture that's exactly right to implement it, which a culture that can teach people how to do this, that is now charismatic for some, it's anti-charismatic for others. And that de facto, it's the compounding rate of return on that stack. And to Shyam's opinion, the opinionation we have about how to do this, it's essentially allows you to express your tribal knowledge of your enterprise in a way you could never do it before, on the terms of your enterprise, with unit economics that are heretofore impossible to do. And that's what's happening in this country, and really in 90% of our market, which explains like the 49% growth and the rule of 83, despite what would be viewed on the outside as large ineptitudes in sales and go to market and how do we interact with people, and our opinionation, both on the outside, on the inside, and with the frontline customer, which is like, we're not agnostic to using our software as shelfware. We are not in the shelfware business, which is another reason why pressure in the government really helps us. We've never done shelfware. We don't do shelfware. We don't think our personality can afford shelfware.
Thank you, Alex. Our next question is from Mariana with Bank of America. Mariana, please turn on your camera and then you'll receive a prompt to unmute your line.
Afternoon, everyone. So I have two questions. First one is on the European defense buildup. You mentioned warp speed and how that has been successful here. Like, are you interested in applying that as these European countries build up their own defenses and catch up on industrial capabilities that have been underinvested for like many, many years? And the second one is, I think investors are pretty familiar with this like software versus services type of like Palantir approach, because you have been like actually leaders on that trend. But Titan is a great example on how like software actually played a role that was more intuitively hardware. Where else you actually have opportunities for software to add value there? Like, is it Golden Dome? Is space communications? Like, have you think about that?
Yeah, on the first one, Alex may have more to say as well, but we would love to help Europe on the manufacturing challenges around rearmament, and I think there are a lot of them to do. The precondition for warp speed is understanding that the existing manufacturing stack is broken. And so you could say, why did America get there first? Because you have all these people who are essentially the progeny of Elon, who have learned and understood how to actually make things, the sort of brains that go from the Raptor 1 to the Raptor 3 engine. And that's proliferated around the community that's in El Segundo and even beyond. That's like the basis of reindustrialization in America. And so it's when we work with the new defense champions, new industrial champions, like it's a very short sales cycle, because they recognize like that what we're doing with warp speed is exactly what they need in order to do it. When you work with some of the older manufacturing customers, even in the US, it's heterogeneous. Some of them are already there, they get it, they realize it. Some of them are going to be there because it's just a reality. In Europe, there are some green shoots, like some very well-known manufacturing companies have kind of said like, oh, I now understand that my ERP thing doesn't work and warp speed, maybe we should get warp speed. So I just don't want to commit too much. I think a lot of it is where's the customer's head at, but we could obviously do a lot to help you.
Look, Europe doesn't get AI yet. It at some point in the future it will. And then, as you know, Europe is not Europe. You have Eastern Europe, you have Germany, France, you have they're very different Europes. Europe that is scared understands that you're going to have to do software, hardware, hybrid systems, and our products are very, very well known and differentiated. It could take a couple years for Europe to understand that you just can't spend money. You're going to have to spend it on things that actually work, and work means spending it on people that have actually done this on the battlefield. I would say our plan is to continue to be roughly in the zone where 90% of our business is growing like it is now at 49% with this rule of 83, and somewhere in that range we guided to rule of 80. And that's going to be primarily driven by the US. I would say as a unknown variable, we're seeing very significant demand for our software, our government software around the world outside of Europe. And those are early days, but you know, the demand, the signal there is very strong.
And then on the Titan point, I think that's an excellent point and is going to be a big part of the future where you're really thinking about how do you build your hardware around the software. You know, there's some classified projects that we have as well, where the first step to building the hardware is not to build the hardware. It's actually to build the mission payload and the software that can execute the thing, and then work backwards from that to figure out what is the hardware that you ought to have around that. And this plays to this, like it is actually a cultural impedance mismatch. Like if you're a hardware company, you think about the world the way that a construction person would think about building the house. You have to pour the foundation first. You can't do anything. But actually with software, you have to build the kitchen first. If you don't, you're gonna get it all wrong. And so I've seen a lot more of the next gen programs are starting to think about how do we build the lethal software first, and we'll figure out how to wrap the hardware.
One of the most interesting things about the current environment we're in is something Sham was alluding to, which is, and again, it's a European versus American. People assume if you're world class at hardware, you'll be world class at software, and they're interchangeable. It's just not true at all. And like the skills and the taste you need to do software is a completely different thing. And America's unique advantage is hybrid software, hardware, software, and any program that's trying to outpace and beat our adversaries it basically is going to have to begin with a software first or software hardware hybrid program, because otherwise we're at a disadvantage. And also the resourcing and the way you organize is going to be suboptimal in this country. Conversely, this is one of the challenges that some of our allies and our adversaries have. You know, the role of taste in getting these things to work, tribal knowledge and ability to do it, is really, really underestimated.
Thank you. Alex, as always, we have a lot of individual investors on the line. Is there anything you'd like to say before we wrap up the call?
You know, this company is organized around giving our friends a really strong shot, I would say unfair advantage, and you know, not helping our adversaries or enemies, and on occasion hurting them. And you know, a lot of you are scattered around the world and helping us in many ways. And we are in a phase where we are very focused on scaling our company. And we really appreciate your support and the fact that you defend us. You know, our support of Western values is often under attack for somewhat idiotic reasons. Our belief that meritocracy will lead us to a better place, that competence is better than incompetence, that competence includes ethics, and the results, the fruits of those labors are here today, but none of that would have been possible without your support. So thank you.
Thank you. That concludes Q&A for today's call.
All right, there we go. Q1 2025 earnings. That is the end of it. We'll stay around for about 15 minutes and give some thoughts. Amir, your reaction to that?
Yeah, nothing spicy this time around. You know, like last time we had a lot of gold and stuff. I think what's really important during these calls, they started to do that more now on the AIP calls. It's really highlight the time to value. They started off the call like the prime time when people are really paying attention. Like, okay, in Q4, someone attended a boot camp, and what was it, like 4 months later they signed a X amount of $1 million annual contract value, like just proving like, okay, you have a boot camp, within months you are up and running, like you sign a deal, you're ready to go. So I think that's really important, and they kept talking about that point, especially the questions around you know, what's future government revenue going to look like. And they just highlighted what me and you might know, and Matt, of course, in the chat. But what a lot of people out there might not know is like regulatory environments, tight schedules, like general difficulties surrounding missions. It's really like just made for Palantir. Like no one executes at the same speed with the same outcomes as Palantir. So they're really, really strongly positioned for government. And the slide deck came out during the call, 124 net dollar retention, which was just amazing. So I'm sure we're going to get into the nitty gritty details and analyze everything for the Palantir Weekly. But yeah, I mean, if I had to rate the overall quarter, to be honest, after the initial like revenue expectation miss on my end, let's say like this is a solid like 8 out of 10 quarter. Like this is a great quarter for Palantir. Like in aggregate, like I don't have anything much to really harp on. If I can share just 2 slides, maybe.
Yeah.
Do we have time?
Yeah.
So they mentioned this. As I mentioned, every single earnings call since they went public, they talk about Europe, and I'm gonna show you why. So here we have, you can just see this is from Q1 of 2022. You can ignore these lines. We don't need to look at like the growth, but just look at this. It's done nothing for 3 years now, just static. And for this quarter, they actually decreased quarter over quarter by 10%. International commercial revenue. So as I mentioned, the only really bearish point, and he addressed that during the call, like sooner or later, like GDP growth in Europe is like less than 1%. I mean, they will have to catch up sooner or later. When is that time? Who can tell, right? But yeah, this is the only bearish part about Palantir, and it's like bringing down the other parts of the business. As you can see, flat again on non-US government. However, the things that are doing well, US commercial, of course, 70%. And if we exclude SPAC revenues, actually it was 98%, almost 100% organic US commercial revenue growth, which is, I mean, US commercial is on fire. And as I mentioned, what allows for Palantir to really scale so well, so 2 important things: the margins going up. He addressed that, like the rule of 80, the quality of revenue. So the margins is one thing. Margins were great this quarter. The other great part is actually a majority now, for a year's time, a majority of the growth is coming from existing clients, not new ones. So that just proves that whole a sales go-to-market strategy of you acquire a customer and then you scale them. 24% of the 38, 39 came from existing customers, and only 15% from new ones. So those are like really core parts to this business, and they are all looking very healthy to me. Like US on fire, government did great. We don't have to look at the chart. I mean, US government did great, commercial did great in US. Only negative part, honestly, like I don't really mind about like my expectation about revenue. 38-39% is great. The only thing is international, and that will naturally turn around, or Europe is pretty much doomed because the economy is not growing. That's my kind of summary. So 8 out of 10 quarter, I would say. Score. Really good.
Matt, your reaction to that call on Palantir?
I thought it was short. I think somebody said something pretty brilliant in the chat. Sometimes it's a cesspool there, but I thought this was pretty funny. They needed more table pounding. I kind of agree. I think the call was shorter than expected. I think there's a lot of information in the actual slide deck itself that should be very highlighted. And I don't want to say they skipped over it per se, but there was a lot of great opportunities and contracts that were signed within the quarter. And I think that shows up in the numbers. And with that, I'm a little bit surprised that they didn't go over it to be quite honest. But overall, a good quarter. I can't complain with it. I think continued growth with respect to customers. And I do want to highlight, I think you're right, Amir, with respect to the European side, quite disappointing. And you have to think that that's with the growth in NHS. So it's like NHS, which was a great move in the right direction, is being partly offset by obviously other customers either shrinking their usage of Palantir or just getting rid of it in general. I know that is like Ferrari, for example, was somebody that is no longer, or at least rumored to be, because they're no longer a sponsor on the car. And several other European countries, I'm sure, have been lowering their exposure to Palantir. And I just kind of question why, especially if you're seeing such efficiencies coming out of the US counterparts. Why would not they want to be? And especially you brought up something brilliant as well. Not much GDP growth going on in the entirety of the EU. I'm sure there's some sectors of highlights, some countries doing better than others. But if that's the case, you need to reinvigorate and make things more efficient over there. It just kind of scratches my head why they would not want to grab onto something like this. And maybe it is the fear of having another country's artificial intelligence platforms attached to your company or your country or your group versus having an ingrown sort of solution. I know that was part of, at least from what I understand, really the problem that's been happening in Germany, where they've tried to create an ingrown solution for AI and progressing forward, and it hasn't necessarily, in my kind of awareness of the sector, hasn't really gone anywhere. So I'm kind of curious if hopefully over time we really start to see this turn around, because I thought that was a phenomenal graphic that you showed, that really it's been flat. If you kind of remove some of the ups and downs overall, I mean, overall flat for the past better half of 3 years. And all we've been seeing is growth when it comes to total customer count in the United States.
Yeah, I would tend to agree. I think that on Palantir Weekly, so on Friday, 11 p.m. Eastern, if you're new to the channel, we will be doing a much more in-depth read of these numbers. Give us a couple days to kind of go through everything. In terms of the actual call, I thought the call was fine. Yeah, it wasn't as energetic as it was last time. And, that's just the nature of the company, and it's growing, and every single call is not going to be a party. So this one, yes, it lacked a little bit of energy, but I don't think they needed that much energy. Obviously, the stock is down 9%. So in general, people are a bit upset. The energy is down probably for a lot of people. I think from that perspective, all you can say is, hey, this stock is up more than 10x from the lows. Unrealistic expectations are going to lead to unrealistic outcomes. If you bought the stock at 125, expecting it had to go to 150 tomorrow or after hours, that might just not happen, right? And so, if you've been here for a while and you wanted to add some more shares to your share count and you did what you did, then it is what it is. But if you are starting the position at 125 without looking at any of the multiples, any of the growth rates, any of the valuation, stock being more than Salesforce's market cap, expecting it to pump, sometimes that doesn't happen. And look, this happened to NVIDIA last quarter. A lot of people thought, all right, it was beat up at 120 it's ready to pump to 140, went down to 115, right? And then the next day it was at like 105. So this stuff happens. It happens on earnings. It is what it is. There's not much you can do about it other than knowing that this is the nature of the market. Sometimes you get it right, sometimes you get it wrong. But the stock itself down 9% to me is absolutely irrelevant to the quarter. And I feel like we can say that on the call right here because we've been in this thing for 4 or 5 years. And so we didn't expect it to be at 100 in 2025. The company, through their SEC filings, had disclosures that they didn't really expect it to be at 70 until 2029. So this is ahead of everyone's expectations. It's going to be volatile. The actual business itself, I believe, was an incredible quarter, 39% top line growth, rule of 40 at 83%. And I think that's only going to continue to go. And although Karp wasn't banging on the table type of excited, you could tell he was saying, hey, this is a revolution. There's winners, there's losers. Right now, there's entire continents that are not winning. There is parts of the world that are winning. Palantir is winning with them. And eventually the rest of the world is going to realize that you need to be winning in this AI revolution. And Palantir likely will be the choice that they go with to continue winning. So there we go. Those are my thoughts. Any final things, Amir, Matt, on this call?
Yeah, honestly, the stock price had a lot of expectations baked in. To be honest, I'm completely fine with -8%. If it goes down -10%, I think that's a good outcome from this quarter. I mean, I was expecting a lot worse because, from a valuation perspective, they would have to do a lot more to justify 125. So being down 8-10%, whatever, I'm completely fine with that. I think I think the quarter itself is good. Fundamentals are improving immensely. The core business is doing amazing. The quarter was great. Yeah, nothing to add. I mean, we'll go into the details on weekly. So yeah, I'm very happy.
I think the stock is still overpriced. I mean, that's, given. But at the end of the day, I'm with Amir. The fundamentals of the organization continue to do well, 39% year over year, on top of I think a pretty decent year last year is pretty good, and you can't complain about that. The thing that I'm most concerned about, which showed up positively, was the margins, and it showed up well. I mean, I was not expecting a 24% print on net income margin, and that just goes to show you, the trend that we're on. I mean, it wasn't too long ago, 10 quarters ago, that we didn't even have any income margin. And now we are 10 quarters in of consecutive GAAP profitability. We're at 24%. And where does it stop? I can see this thing 5-10 years down the road getting to $15 billion in income and having a 40% net income margin. We're talking about some real revenue and income at that point. I mean, if you just think about it, you're at $20 billion, let's just say, at a 40-45% sort of net income margin. The multiples will start to come down pretty quickly. They're at 500x now from a price to earnings perspective, but you continue at these sorts of margins and 39% year over year revenue growth, it won't be long until you're below 100x, even if the price kind of stays here or slightly increases from here. So, somebody said it to me. They were like, Matt, it's in its infancy, blah, blah. It's like, yeah, it's been 10 quarters, but, it is still overvalued here, but it'll come down over time, and it's making the right moves. It'd be a different thing if it was still under 30% year over year revenue growth.
Yeah, I would agree. I think all of us have acknowledged the valuation is expensive. Anyone who's been in the Palantir community for a long time and is not just looking at the stock, like $100, but is actually looking at everything else associated with it, knows that it's expensive. But in the midst of that, this is a unicorn company that we think can eventually grow into the valuation. On a day like today, the market doesn't want to help it grow into that valuation from a stock price. Actually, no, it is helping it grow into the valuation, because when Palantir goes down, stock goes down, valuation goes down, growth looks a little bit better compared to where it was if the stock was up right now. And so it is what it is. So I think all three of us, at least here, are going to sleep really well at night. And I'm sure a lot of people are going to sleep well at night, regardless of an 8% dump. But the business itself is doing well. And I think that's the biggest thing that we all cared about.
Yeah, just a final slide. A lot of people, I don't hear it as much anymore, but a lot of people are harping on SBC for Palantir. Finally, we moved below significantly that 20%. Like, if you compare SBC to revenues, like, of course, it's been going down over time here, but finally we have it at 18%. So significantly below 20% that it's been kind of stuck at. Like, we were waiting, when are they gonna drop that SBC as a percentage of revenue? Finally 18%. So that's another huge positive for the business. So yeah, we'll get into it on weekly, like how it compares to other businesses in the SaaS space. But yeah, that's my final point that I think is it's a great showing from Palantir.
Yep. I mean, that only, let's take, for example, like that looked like it grew from like 140 to 155 over the past trailing 12 months. So that's like less than a 10% increase. So like you stated, if you're able to continue to grow revenue by 30-40%, hopefully over time we get that to below 10% and eventually get to a place where, when you take into consideration continued share repurchases, etc., we get to a place where we actually start to reduce the outstanding shares, which, man, can you believe it? Like, if that start, you literally have everything going in the right direction except for share-based compensation. If that begins to be a place where we actually shrink the share count, that'll be crazy where the share price actually starts to go.
Yeah, and someone said, does that mean they're not hiring lately? Yeah, I mean, they've had 4,000 people for a couple quarters now, so they are doing all of this while remaining very efficient. And I don't think they plan to hire that many more people unless, they just can't deal with the demand. So that also should help those operating margins continue to scale and inflect over the coming quarters. All right. Thank you, everybody. We appreciate it. Amir and Matt's YouTube and Twitter in the description. Please make sure to check them out. Thank you all for being here. If you're new to the channel, we talk about stocks, and Palantir is one of the main companies we follow for the past couple of years. Amir and Matt have been following it as well. And we'll be back on Palantir weekly on Friday to go into these earnings more in depth. Thank you, everybody. Appreciate it. We'll see you guys tomorrow.
Bye-bye.
Bye-bye.